Alrighty. So in today's video, I'm going to be sharing with you a no loss option strategy, which is something pretty controversial, right? Because if you have been watching a number of my videos, then you will notice that I've been saying that, there is no strategy that has absolutely no risk, right? Because if you put on, any strategy, you risk your capital, there's always, some chance that you're going to lose some money. So basically, no such thing as a 100% win rate kind of strategy, right? So why did I actually create this video to share with you, the title as the no loss option strategy? Well, believe it or not, you'll be pretty surprised that I do have some people that actually, reach out to me and ask me questions like, Davis, can I have, a strategy that have no losses, or is there any strategy you know of that has a 100% win rate or at least 99% win rate? Well, the answer is that there is actually one strategy that I know of that is the closest to being a no loss option strategy, right? So I'm going to be sharing with you in this video. So are you ready? If you are, I'm going to do some drum roll. So the closest thing that at least I know of to being a no loss option strategy is the wheel strategy. Now, before you start saying what the beep or your mother beep and all sorts of cute and adorable words you're about to throw at me, which I appreciate, by the way. No, don't say that to me, guys. My feelings will be hurt. But the wheel strategy is the only strategy that I think is the closest to being a no loss option strategy. Now, before you start to get very angry and start to slam the table and start to, punch the screen just to reach out at my face, there is an asterisk that you need to take a look at, right? As you can see down here, I have a very clear big asterisk down here that you need to see. So this is what you call a fine print that you need to read. So whenever you see any documents, right, that has an asterisk at the end of the sentence, you need to know that there is a fine print, right? The fine print means you better read it or else, things might go wrong. So here's the fine print. The fine print is only when traded in a certain way, right? When you trade it in a certain way, there are a few criteria, which I'm going to be sharing with you, of course, right, in this video. I'm not going to just leave it to you, just saying the wheel strategy and you trade it and all of a sudden you lose money and then you come find me, right? No, I'm going to actually share with you the criteria. So the wheel strategy can be pretty much close to a no loss option strategy if you trade it in a certain way, right? If you trade it the right way. Now, when I talk about the wheel strategy, there might be two camps right now, right? The first camp might be thinking or saying, hey Davis, the wheel strategy is a no loss option strategy. I've been using the wheel strategy for a long time. I've not lost money. What are you talking about? This is obviously a no loss strategy. Well, if you're thinking this way, then I'm going to give you a wake up call because it is not a no loss option strategy, at least just by the design of this strategy. Because if the market crashes, if the underlying that you choose goes to zero, you're going to lose a lot of money, right? You're going to lose pretty much everything that you put into the underlying for the strategy, right? Now, the other camp might be saying, Davis, you're more cute and adorable words thrown at my face. Then I want to tell you that, hey, you're right? Because the wheel strategy can actually lose quite a lot of money if you don't know what you're doing, right? In fact, I agree with you that the wheel strategy can be risky depending how you trade. So in fact, I'm actually going to share with you some horror stories that I went to the web to, scour the web to find out for, right? So here are a few wheel strategy horror stories. So before you go ahead and, just stop the video thinking that, oh, the wheel strategy is a no loss option strategy, I'm just going to dive right straight into it and trade it. Watch this first, right? So I went to the web and just typed, wheel strategy, horror stories, and a few stories just came up on Reddit. So as you can see down here, this person over here, he sold the TQQQ puts at 150 when it was 174. So seemingly, it seems, pretty safe. By the way, TQQQ is not exactly the same as QQQ, which is the, tech index ETF. Now, TQQQ is a leverage index ETF. And when you use a leverage index ETF to trade the underlying, you better know what you're doing, right? Because it's very different from trading the QQQ, right? Although you get much more, implied volatility, you get higher premiums, there is a mechanism that you need to be aware of, and that is the daily reset, which makes the whole strategy doesn't really work when it comes to option strategy. So as you can see down here, he says his losses is in the whole of something like $2,500, right? So he says, I knew the risk, so I'll just keep selling above my cost basis until I'm at least even and probably switch to the normal QQQ. So he realizes that the TQQQ is a little bit too good to be true, right? That you can keep selling, the put options and call options with a lot of premium, and then, you think that you're going to make a lot of money. Well, always a catch, right? So always be careful. The next one, right, as you can see down here, he says, I'm sitting at a $3,500 loss, right? Again, same thing, right? Real strategy, if you get the timing wrong and the market just crashes after you get into the trade, then you're going to be in for a very, roller coaster ride where your emotions going to be up and down, right? Because you're going to see that the market, if it doesn't recover, it doesn't go back up to where you sold your short put at, going to lose a lot of money, right? Another one as well, you can see he did a wheel on Macy's and it shot through my strike. I was never able to get my cost basis back, right? And then another one, I sold a $140 put on AYX right before earnings. So one of the reasons why I don't like to trade earnings is also because of this, right? It's pretty much like a gamble in a sense, because the earnings can really make the price move a lot, right? Either a huge gap up or gap down, and that can really affect your trade, right? Especially if you are to trade something like the wheel strategy over there. So as you can see, this one trade wiped out literally months worth of profits. And finally, this is from one of my YouTube subscribers where he just shared with me his trade that went wrong when he did the wheel strategy. As you can see, he went pretty much all into Tesla. As you can see, quite a lot of Tesla trades down here, and he went down roughly about $116,000. So as you can see down here, the wheel strategy is not a no loss option strategy, right? Not by any stretch, right? You can really lose a lot of money, especially if you don't know what you're doing. So the question is that if the wheel strategy is risky, how is it possible that you can make it into a no loss option strategy? All right, so bear with me. I'm going to walk you through a few criteria that you do really need to use in the wheel strategy in order to make it to be the closest thing to having a no loss option strategy. So first of all, let's just have a overview of what the wheel strategy is in case you're not familiar, right? So let's put everybody at the right track so everybody have an understanding of what this wheel strategy is. So the wheel strategy is actually a pretty simple strategy. First off, you start off by selling a cash secured put. So basically with a cash secured put, what it means is that you actually intend to get assigned on this option, right? If the market goes down below this cash secured put, and then at expiration, you're going to get assigned 100 shares per option that you put on, right? So make sure that you have the necessary cash for this underlying. Now, the next step is to get assigned, like I mentioned, right? So if you're not assigned, well, you just have to sell the cash secured put over and over again until you get assigned, right? So the cash secured put, whenever you sell it, you get some premium, all right? So once you're assigned, the next step is to sell a covered call. Now, the covered call can be either at the money or out of the money, all right? At the money just basically means that you're selling it exactly at the place where you got assigned those shares, right? So basically what you're doing is that you're just getting the premium from selling the covered call. You also got the premium from selling the cash secured put, and there's no capital gains, right? No capital gains because you are buying sort of like you're getting assigned the shares at the same price, and then you're getting it called away at the same price. So there's no capital gains there. But if you want some capital gains, which means it's the profit from the difference of where you got assigned the shares, long the shares, and then you get out the shares. So as you can see down here, let's say for example you put the cover call at 175, then let's say if the market goes up and your shares get called away, then this is where your capital gains is. It's just basically the difference. So this is pretty much just the wheel strategy, right? It's pretty simple. So all you have to do next is just rinse and repeat, and then just do it all over again. Now that we all have the same understanding on what the wheel strategy is, the question is, how do you turn the wheel strategy into a no loss strategy, or at least the closest to having a no loss option strategy? Well, there are a few criteria, and actually, there are three criteria that you need to implement. So, the first criteria is called vertical diversification. So, what exactly is vertical diversification? So, vertical diversification is the opposite of horizontal diversification. So, horizontal diversification basically just means that you have multiple different stocks and then you are training the strategy on it. So, let's say, for example, you have stock A, B, C, and D, and all you're doing is just doing the wheel strategy on each of them, right? So that means you are doing just one cash secured put down here, another cash secured put, right? So -1 down here, -1, -1, -1, right? And then if you get assigned or any of them, basically you're just going through the whole wheel strategy routine. So this is what is called horizontal diversification. But horizontal diversification has one flaw, is that when the market crashes, everything goes down, right? Regardless of, the sector, or at least most sectors will actually start to crash, as you've witnessed during the pandemic as well as in 2022, which is where a lot of people actually got caught in their wheel strategy. So if you had many, many different stocks back then and you're doing the wheel on them, then you notice that all these stocks will be pretty much caught, in a sense whereby the price of the underlying will be way below where you sold your cash secured put. So that is why I don't really like doing horizontal diversification by itself. What I would suggest is to do what is called the vertical diversification. And that means to have multiple levels instead of just one, right? So if you use just one level and you're wrong on the timing, you could get stuck in the trade for a long time, or the stock might just not go back to that level, right? So for example, if you did it on PayPal around 2022 or late 2021, then you're probably still in that trade, right? Suddenly a short-term trade has now become a long-term investing trade where you're hoping to finally break even when you get your pension. So instead of putting the wheel strategy in terms of horizontal diversification, where you split your capital into different underlyings, vertical diversification is, instead of you selling just one, you actually sell multiple, right? You don't just sell one. You have many, all of this cash secured put as the market goes down. So what you're essentially doing is that you're sort of like averaging down as the market goes down. You're entering into the trade as it goes down. And then when the market goes back up, you can start to sell covered calls for the different levels, right? So the market, as it goes down, if it continues to go down, you're always just selling, the levels. There's always something for you to do, rather than you getting stuck with, all the underlying down here, and then there's nothing to do. Because if all your stocks, are pretty much deep underwater, then there's not much you can do. You can't really sell a covered call as well, because it's just too far away for you to sell the covered call to get any premium, right? So vertical diversification. Now, you might be thinking, Davis, this is so risky, right? Because what if the stock goes to zero? So hang on to your pants first. Hang on to your pants. And if you're not wearing pants, why? Please go wear some pants before you continue watching the rest of the video. Okay? Okay, Davis, stop that. Now, I do understand that, of course, it's going to be risky, which is why there are two more other criteria. All right. So hold on to your horses, hang on to your pants, wherever it is. I will get there in the next few slides. Right. Now, how do you actually, place those cash secured put? I actually went this in depth in other videos. So this is pretty much what is called the income grid wheel strategy, right? Just go to my channel, search for income grid wheel strategy, and you'll be able to find quite a few videos on that. But generally, how we want to split up this cash secured put, the levels, is based by, either fixed dollar intervals. So maybe you want one that is $10 apart, all right? Just as example, okay? Or maybe percentage wise. So maybe you have decided that this will be around 80%, then maybe this will be 75%, then this will be at 70%, and maybe you want to go all the way down to 50%, thinking that maybe the underlying, it's pretty difficult to get to 50%, and if it does, it'll be a pretty nice discount on the underlying that you actually want to get long anyway. So vertical diversification is the very first criteria, and you definitely want to choose it on a stock that you want to own, right? Not just go for a stock that has high volatility and thinking that you're going to get a lot of premium, right? I'll stay away from that. So that is why we're going to move on to the next criteria, and that is choosing a proven underlying.
By the way, if you like this video so far, please subscribe and also click the thumbs up button, and also do get your free copy of the Options Income Blueprint, where I share the top 3 option strategies that help you generate a consistent income each month, trading just 1 to 2 hours a day, right? So if you want to go ahead to get this copy, just head on over to optionswithdavis.com/blueprint. All right, back to the video.
So this is very important, right? This is paramount to whether this strategy is going to be no loss or full of losses for you, right? Or maximum loss for you, because the underlying really determines whether the real strategy is going to be successful for you or not, because this is a bullish strategy. The market needs to keep going up. If the market crashes, no matter how many levels you have, using criteria 1, using the vertical diversification, it goes to 0, you are going to lose everything that you have, right? So proven underlying is going to be very important when doing this wheel strategy. So what exactly is proven underlying? Well, basically, it's fundamentally good stocks that have increasing revenue and profits. That is the very first point. So I want you to take a look at these 2 income sheets down here, this 2 income statement. The one at the top, you can see that the revenue in blue and the net income in yellow, as you can see, it's pretty erratic, right? The revenue is going down, going up, going down. And the worst thing is that your net income, as you can see, it's all in a loss. So if you take a look at this kind of stock, although it may have very high implied volatility, is this the kind of stock that you want to get into for the real strategy, right? Because if the company is not profitable, then chances are the stock price is not going to be that good, right? Because the income statement, or rather, the net income, profit and loss, whether it's making money or not, it's going to be reflected most of the time in the stock price. All right, so let's take a look at the next one. So this one, as you can see down here, so much better, right? You can see the revenue is increasing. The net income is also pretty much increasing year on year, and it has been profitable for the past 5 years, right? So these are some things that you want to take note of. So when it comes to fundamentally good stocks, there are quite a number of criteria, right? For example, you might want to look for stocks that have good moat as well, so on and so forth, right? So generally, just as a snapshot, I like to look for increasing revenue and income, and that it has been profitable at least for the past 5 to 10 years. So you know that the company is at least going to be around, and it at least have a track record that it's making money, right? Because remember, all the stocks that you're trading are all actually companies, right? And if the company has been losing for many years in a row, well, there's always some chance that it's going to go bankrupt and shut down, right? If it shut down, then everything they put into the stock, right, just goes to 0. Now, the next point is that it has to have been around for at least more than a decade, and the longer the better, right? If you want to put into stocks that have just IPO'd recently, then it's going to be so risky because you have no idea whether this company is going to survive or not, right? Because a company going IPO doesn't mean it's going to stay there forever. You've seen many stocks that have just gone bankrupt after going public, right? So that is why if a stock has been around for at least 10 years or longer, then you know that this company is pretty solid. So that is the next thing you really want to look out for. Or if you're not good at selecting stocks, then the simple way would be to go for broad-based equities index ETFs, right? So there are quite a number, but the thing is that most of them are pretty expensive, right? For example, SPY, QQQ, IWM, and all these index ETFs, right? There are, of course, alternatives. You can go for the cheaper ones, like, for example, XLK. The tech stock is slightly cheaper than QQQ. You have also, XLF, which is the financial index ETF. And, right, so this is something that you do want to look out for. So the trade-off is that index ETFs, broad-based equities ones, they tend to be slightly safer to do the wheel, but you're not going to have that much premium, right? So maybe the trade-off for that, the strategy would be to sell an at the money option so that you'll be able to get slightly more premium then if you sell out the money, right? But I'm not go in depth into how you want to sell that, right? So I'm just going to talk about how to make it a no loss wheel strategy, and based on criteria 2 is to choose the right underlying. Now let's get on to criteria number 3, and that is to have strong technicals, right? So if you have fundamentally good stock and you have implemented the vertical diversification, still not really enough, because you also want to look at strong technicals. So what is strong technicals? So strong technicals basically just means that you want to look at the chart and you want to go back at least a decade, right? So first off, again, you want to see that the underlying has been around for at least a decade, and that it has survived many crashes. And crashes, by that I mean those times like 2008 financial crisis, pandemic 2020, 2022, the bear market, and all the other times where there's a crisis, right? Maybe not having to do with the company, like for example wars going on, Middle East wars, or maybe trade war. So all this, you want to take a look at the chart to see how the company has actually performed under those circumstances, and whether has it kept making new highs. So again, take a look at these two stocks down here. The first stock, as you can see, wow, this is just so erratic. You have no idea what's going on, and then it comes down. Imagine you did your wheel strategy somewhere around here. Well, good luck to you. You're probably never going to see your money again, right? Most likely, if this stock doesn't go to zero, and if it's still not profitable, you may have to pass this stock on to your grandchildren for them to finally see if the stock goes back up, right? Otherwise, other than that, I don't think you're going to see your money in this lifetime, right? So you can see the first chart down here is just too erratic for you to do the wheel strategy. Now, whereas the second chart, as you can see, the market just kept going up and up and up despite all the crashes. So as you can see down here, 2008, right, somewhere down here, this is the subprime crisis. It looks like it's very small compared to where the rest of the, where it ended up in the future, right? But if you were to just zoom into this period down here, this crash is actually pretty big, right? 2008 financial crisis, many stocks just dropped like 50%, right? So this probably had a very large drawdown, but in the big scheme of things, over a very long time, it's so minuscule, right? Same thing somewhere around here. I think this was around the pandemic, 2020 crash went up. Down here, 2022, around here, the market, went to bear market, and then now it's at all-time highs again. So I know that this stock is pretty strong. And by the way, it actually corresponds to this income statement, which I showed you down here. So the very first stock which you saw is this one down here. As you can see, this have a very lousy income statement, whereas the one at the bottom, very good income statement, and again reflected in the stock. So if you're wondering what stock this is GME, GameStop, or is it AMC? One of them, right? And this one at the bottom is Google, right? Or Alphabet, the company, right? So as you can see, it's very important that when you're doing the wheel strategy, that you need to choose the right underlying, right? That is the paramount, apart from having strategy in terms of the options. So when you have the three criteria combined, right? Criteria number 1, you have vertical diversification. This is to avoid being right on the direction the moment you put it on, because you may have criteria 2 and 3 where they are good stocks, but you may have the timing wrong, right? If you had the timing wrong and you enter into the wheel strategy without any vertical diversification right at the top, then you're going to have to hold on to it for quite some time, right? Especially for those people who went into, those stocks around, the early 2022. So because of that, we want to implement this vertical diversification. So you don't really have to worry about timing, because if you have multiple levels as it goes down, hey, you're going to be happy, right? Because you know that if the underlying is going to go up in the long term, then all those at the bottom, if you get assigned, you're going to have very good entry price, right? It's going to be so much lower and much easier for you to, again, get out of the position using the covered call as per the wheel strategy. So criteria 1, vertical diversification. Criteria number 2, proven underlying, right? Proven underlying, again, very important, because if the company is not profitable, well, sooner or later that stock is going to go nowhere, right? Or maybe even go bankrupt. And finally, criteria number 3, strong technicals, because there are certain stocks that have proven underlying, but the technicals may not be strong because of maybe certain country sentiment. For example, if you were to go for stocks like Baba does have pretty good fundamentals. As you know, it is a profitable company, but because of the economic situation in China, well, it's not doing well, right? So those people who have gotten into Baba for quite some time, then you're probably still stuck. So that is why, looking at criteria tree is pretty important as well. You want to see the technicals that is pretty strong, that has just kept going up, right? So when these three combine, you should have, pretty good results, right? So as you can see down here, I've been doing the wheel strategy, more accurately, the income grid wheel strategy on some of the underlyings, right? Like, for example, QQQ, Amazon, Google, and Meta. So some of these are pretty expensive. In fact, all of them are pretty expensive. So you do need quite a bit of capital, but there are some, underlyings that is much lower price as well. So again, not a trade recommendation for you to do any of this. This is what I have been doing. As you can see, it has no loss so far, right? Because I've stuck to these three criteria, the market has just kept going up, right? As long as the market just keep going up, the underlying just keep making new highs, then again, this is the closest to a no loss option strategy that you're going to get in the world of options.
By the way, if you like this video, then you're absolutely going to love this next video which I have for you, so go ahead and watch that video right now. Also, if you haven't already gotten your free copy of the Options Income Blueprint, you can do so just by clicking this link down here on your screen and you'll be able to get it for free. Alright, I will see you in the next video.